Fed has had really easy monetary policy. So what does that mean? Well, they have one of their tools called the Fed funds rate. This is not mortgage rates. This is a very short-term overnight rate that they control, and they can either raise this or they can cut this. And this will have a direct impact on their monetary policy and the economy, but not exactly how you think. So what the Fed has been doing for a long time is keeping that Fed funds rate essentially at zero. Now, they do this to stimulate the economy, but on top of that, they've been doing a ton of asset purchases. So they've been buying mortgage-backed securities and treasuries every month. And they were buying $120 billion every month, which is a massive amount. And they have actually amassed a balance sheet of almost 9 trillion with a T dollars. And I feel like we've become kind of sensitized to some of these numbers. You know, the US is 30 trillion in debt right now. The Fed's balance sheet is 9 trillion, but it's a massive, massive amount of money. So there's some consequences to having easy policy like this. One of them, which, listen, you guys listening to the call have all been feeling, it's inflation. And inflation is now up 7% on a year over year basis as measured by the consumer price index. Now, this is, you go to the store, you go to the pump, food, gas, everything's more expensive. So the Fed's been put under a lot of scrutiny and pressure to remove some of this accommodation. So what the Fed has basically come out and said, now back in November, they said, hey, listen, we need to start removing some of this. And they said, we're going to begin tapering. That's that buzzword that you guys have heard about. Essentially what that means is buying less. So initially they said, hey, instead of buying 120 billion, we're going to cut that by 15 billion. And they were buying 105 billion. Well, then in December, they doubled that pace. So they were reduced it by 30 billion. And then they've come out in their meetings and in their discussions, and they said, listen, we are going to hike rates. And the time that they have this thing called the dots plot. And it showed that the Fed wants to hike rates 3 times in 2022 and another 2 to 3 times in 2023. Now, since then, there's been some different estimates thrown out there. But if you look at what the Fed futures market is, which is basically like the market's expectation for how many times they're going to hike rates, it's at 125 basis points. So if they were doing quarter point hikes, which is like a regular hike, that would mean 5 hikes. I actually saw Bank of America come out with their estimates, and they think the Fed's going to hike rates 7 times.
Wow.
So you hear this, right? And I think your consumers hear this. And what do they think? They think that the Fed is hiking mortgage rates.
Right.
It's not the case. So the federal funds rate, as I mentioned, is a very short-term rate. So when they hike that, you do see short-term yields moving higher.